Right, hi everyone. Welcome to today's live trading session brought to you by IronFX. Right, before we get things going, just take a quick note of the risk warning and disclaimer, right, that the products here are traded on margin and carry a high level of risk, and it is possible to lose all your capital. And so take note that the information in this webinar should not be considered investment advice or investment recommendation, but instead educational material only. Right. My name is Ketan Ramachandra. So this webinar series is brought to you in a special partnership between IronFX and Everest Fortune Group, where we've been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right. Before we dive into the charts and trading view, let's take a quick look at the economic calendar and see what's up, what's left for the rest of this week. Right. It's going to be mostly US data that's going to be released today and tomorrow. Right, today we've got the advanced GDP estimate for the second quarter of 2024, along with unemployment claims. And tomorrow we've got the PCE price index as well. The PCE price index is actually an inflation gauge and is actually the Fed's preferred measure of inflation. Right. So here's the what's left on the calendar for this week. Right, we had German iPhone business climate released earlier today. We're going to have advanced GDP. Basically, is the advanced estimate for second quarter GDP today, along with unemployment claims. And we've also got durable goods, and then we've got PCE price index tomorrow. Now, taking a closer look at GDP, this advanced estimate initially came, the first, I would say the preliminary estimate came in at about 2.4%. Then the first and second estimates were about 1.6 and 1.4%. Now it's the advanced estimate has sort of bumped up a little bit up to 2%. So we can see here, looking at the second quarter's GDP, we're going to see a nice rebound as well. So you can see here in 2023, we had a strong finish in terms of GDP output in the US, right? With GDP growing 4.9% in the third quarter and 3.4% in the fourth quarter year over year. However, Q1, right? Q1 of 2024 saw a relatively low reading of 1.4%. However, we're likely to see economic activity rebound slightly in the second quarter of this year. So the advanced estimate is expected to come in at about 2% later today. Now, looking at unemployment claims, right, basically this is a weekly data point, right? That means it's released every week. It measures the level of, or it tracks the level of American citizens filing for unemployment benefits, right? So that means if you just lost a job recently, this is where you would be end up as a statistic, right? So this is where you'll file for unemployment claims or unemployment benefits. Now, a rising number as what we see here in the second quarter of this year, or rather over the last 8 months, means that there are more people filing for benefits, right? That means there is some weakness in the US labor market. Now, this is something that we saw at the end of 2022 and in the second quarter of 2023 as well. So rising unemployment claims signals a potential weakness in the US labor market, and typically that functions as a bearish catalyst for the US dollar. Conversely, falling claims figures as what we saw in the second half of 2023 signals a robust labor market, and typically this would function as a strong bullish catalyst for the dollar. Now, we can see here over the last 8 weeks, claims have started to pick up and have remained elevated as well. And not only have they remained elevated, they've also been coming in higher than the respective forecasts for most of for majority of the time. So the blue bars are the actual results, the orange bars are the estimates, right? So last week's estimate came in about 227,000, I think, or 280,000, but the actual figure came in at around 243,000, right? So the forecast for this week stands at around 237,000, which is still a elevated figure. Now, looking at the 4-week average, the 4-week average of claims comes in at around 234,000, right? And you can see that this week's forecast is also higher than the 4-week average as well. So claims have trended higher and remain elevated. So if you get another round of higher than expected claims, right? Remember, forecast for this week is 237,000. If we see a figure that's higher than 237,000, this is typically going to function as a bearish catalyst for the US dollar. Conversely, if you do see a number, okay, because more claims signals more weakness in the labor market, and hence this is going to be negative for the US dollar. Conversely, if claims come in lower than the forecast of 237,000, this signals a slightly resilient labor market, right? and this would then in turn function as a potential bullish catalyst for the US dollar. Right, so this is how we can easily interpret the data that's going to be released today at 12:30 p.m. GMT time later today. So take note, the calendar here, I'm on GMT time here, all right? The GDP will be released later today at 12:30 p.m. GMT along with unemployment claims. And finally, tomorrow at the same time at 12:30 p.m. GMT, we've got the PCE price index that's going to be released, right? As I mentioned earlier, this is the Federal Reserve's preferred gauge of inflation. And after looking at CPI data that was released 2 weeks ago. Remember, we had June CPI data that was released 2 weeks ago that showed inflation easing once more in the US. Now, we can see that last month's figure, or rather the previous month's figure, which was May, when we saw a significant drop-off in the monthly change for both the headline PCE as well as the core PCE, right? Headline PCE was coming in at about 0.3% over the last 4 months, and it came in flat in May. Similarly, core PCE was coming in at around 0.3, 0.4% roughly over the last 4 months, and that dropped to 0.1% as well. So lower monthly increases, of course, naturally is going to result in further moderation in this index as well. Right, so for June's readings, right, so for tomorrow, we're going to have the data for June. The forecast for core PCE is expected to increase 0.2%, slightly higher than May's figure. And the headline PCE is expected to rise 0.1%, a little bit higher than the flat reading that we had in the previous month. So once again, not very drastic increases, right? We're not seeing monthly increases of 0.3, 0.4%, but rather more minute price increases. So this should help to ease overall inflation as well on an annualized basis. So if we do get another round of softer PCE index readings for the month of June, right, this is quite likely going to cause the dollar to sell off as well. So remember, inflation cooling is going to be negative for the dollar because that brings forward the Federal Reserve's first rate cut, right? The first potential rate cut could be brought forward. And for now, markets are pricing in the first rate cut to take place in September. Right, there's a FOMC meeting coming up next week, right? There's an FOMC meeting coming up at the end of December, 30 to 30, July, 30 to 31st July. However, the Fed is expected to keep rates on hold next week. However, they may proceed with a dovish outlook as well. They may drop significant clues as to whether they will move ahead with the first rate cut in September. But for now, markets are pricing in the first rate cut in September. And for next week's meeting, the Fed is expected to keep rates on hold. Right. Okay, now let's dive into the charts and trading view, and we'll start the analysis with the dollar index, of course. We'll go through some of the majors, and then we'll look through all the other majors, look through the commodities and the indices as well. And of course, if you have any other requests, or if you have requests for any other instruments, please do let me know in the chat box. I'll be more than happy to go through the analysis with you. Right? Okay. Now, looking at the dollar index, we can see that after hitting a high of about 106.14 at the end of June, this index has tumbled quite sharply as well. However, it did stabilize around 103.70 last week, like last Wednesday and Thursday, and it has since staged a minor rebound. Right, so looking at it here, right, we can see that on the daily time frame, the bias is still to the downside, right? We see a series of higher lows and lower lows, right? It's almost like it was trading, I would say it was trading in a nice bearish channel, right? Prior to Tuesday, right, as markets closed last Friday, the dollar index was trading in a bearish channel here. However, we saw a breakout occur at the beginning of this week on Monday, and there was follow through on Tuesday. However, Wednesday and today we are seeing the dollar index pull back slightly as well. Right, so we did see a nice bullish breakout take place on Monday. Now it's at this point in time, it's still a little bit inconclusive whether this bullish breakout is going to continue or is going to continue to cause dollar index to rise higher. We're sort of in limbo now, right? We are neither in a clear bearish downtrend or in a clear bullish uptrend. It's sort of in limbo, waiting for the next major catalyst, right? So the catalyst could be It's quite likely to be a combination of GDP and unemployment claims tonight. And of course, what is that? PCE price index tomorrow, right? So we have three pretty significant US macroeconomic data releases, which is quite likely going to provide us with the that's necessary catalyst to give us clear direction for the dollar index, right? Okay, now let's just keep this bearish channel in place for now, because the upper trend line of the bearish channel can also function as a potential support line once price has made a bullish breakout. So we can see this bullish breakout take place on Monday and Tuesday, and we can see here that as of now, the upper trend line of the former bearish channel is still functioning as a pretty decent support area here. We can see the bottom of the wicks on Wednesday and Thursday finding support just above uh the upper trend line. So let's just keep this channel on for now. It's still a useful channel to keep. Right. Now, what about resistances? How can we identify the major support and resistance levels? Right. When let's start with support, right? I think it's quite clear, right? This level here, this pullback level here at 103.65, where price stabilized last Wednesday and Thursday, is quite clearly the first support for the dollar index, right? We see a nice pullback taking place here. Price stabilizes around 103.65. Now, the second major support level that I see for the dollar index is at this pullback that occurred on the 21st of March at 103.24. Right. I also see a nice bullish uptrend here, right? Starting from 8th of March, going up to the high on the 16th of April. So we can also run the Fibonacci retracement, right? The retracement will start from here, the 8th of March up to the 16th of April. We can see that the 78.6% Fibonacci retracement aligns very well with the second support. So let's just keep that on and we can remove the rest. Right, now what about resistance? Right, I see a nice pullback level taking place here, and at the same time, I see a recent resistance level at around 104.75 as well. Right, so for now, I'll identify the first resistance for the dollar index at 104.51. And at the same time, I see another little pullback resistance level here at 105.13 as well. Actually, if you stretch it across, it looks like a pretty decent overlap, right? All the way from here, it looks like a pretty decent overlap resistance level at 105.15. So we can use this level and label it as the second resistance here. All right. Hi, Ojo. What's the best way? Your question is, what's the best way to draw a trend line? Okay. Generally, when we're drawing trend lines, it should have at least three touches, right? So three touches here. So for example, when we're drawing an ascending trend line, right, we draw it at the bottom. So from here, if we're starting at the bottom here, we should ideally be looking for three touches here. So in this case, this ascending trend line, by itself is not really good, because why do I say that? Because it only has one touch here, second touch here. Ideally, we're looking for three touches here. But actually here, when you look at it in this uptrend, this is actually a nice bullish channel, right? So it's fine if you cannot identify, if you just using it as an ascending trend line is probably not the best, strongest trend line, but when you draw it as a channel, it's very clear. We have two, three touches to the top and two touches to the bottom. That's sufficient enough to identify as a major channel, right? So for channels, we're looking for at least two touches at the top, two touches at the bottom. Anything more than that is, of course, adds further significance to the channel. And for an ascending trend line, we're looking for at least three touches. In this scenario here, we only see two touches. So this trend line is not really that strong. However, like as I mentioned, when you draw this, or you highlight this uptrend as a channel, that's what gives it further significance, right? Now, here, right, I'll give you another example here. There's a nice uptrend here as well that took place at the end of March, early April, right? We can draw oh, hang on, right? We can draw a trend line here as well, right? There's a nice ascending trend line. And in this case here, we can see we have several touches, right? We have one, two, three, four. Of course, here there's a slight breakout here, but generally you get the idea that this trend line here is good, is actually pretty good. But in fact, this is another bullish channel as well, right? There's actually another bullish channel over here as well. Right, we see a nice bullish channel here as well. And when the breakout occurs through a bullish channel, right, we see a major shift in momentum, and we see a downtrend take place. Right, similarly here for a descending trend line, right? That's for a descending trend line. I'll just use this level here. For example, you have a nice okay, here again, you have one touch here, two, three. Okay, so you've got two touches here, one touch here. So you have a pretty decent descending trend line as well. You have a pretty decent descending trend line at this point as well. And when you actually look at it, it's also another bearish channel as well, right? It's actually also another bearish channel that we can identify quite easily, right? This is also a very nice another bearish channel. All right, okay, Ojo, you have a question. Generally, right, because I'm on the daily time frame here, if I use the daily and 4 hour time frame, typically I'll be looking to use the wicks. I'll typically be using to use the wicks. But if it's the daily and 4 hour time frame, you can also use the body of the candle is fine. But I believe I would say for the lower time frames, right? If you're using the lower time frames, 15 minutes, 30 minutes, then I would say use the wicks. If it's the higher time frames, using the body of the candle is fine. And if you want to use the wicks as what I do, that's also fine as well, right? Right. Hope that answers your question. Yeah. All right. Okay, so moving on. Right, okay, so we've got this downtrend here. Okay, we're talking about resistances. Now we can also draw another Fibonacci retracement on this downtrend here. Right, so this downtrend Fibonacci retracement will start from here, this high on the 26th of June, going down to the low on the 18th of July. Let's pull up all the fibs. Right, in this case here, we can see the 38% retracement aligned pretty well with the first resistance, and we see the 61% aligned very well with the second resistance here. So you can see this overlap level here at 105.15 is indeed a very strong resistance area. So let's keep 38 and 61. There we go. Now that we've identified the key resistance and support levels on the daily time frame, right? Now we can move down the time frame into the 4 hour chart and then try and fine tune the analysis and also try and help us identify potential opportunities for today as well. Right, Ojo. All right, great. Thank you. No worries. Most welcome. All right, okay. Now that we've identified the major okay, there's levels on the daily time frame. I believe this probably, let's try a projection. Let's try Fibonacci projection. This involves 3 points. Projection tells us where price could eventually end up. So let's just see 1, 2, and 300% is here. So in this case here, running the Fibonacci projection, the projection at 100% points to a level of 103.60, and this is where exactly as price was falling down, this is exactly where the dollar index stalled as well. So projection levels like this, right, tells us as price is falling down how far it could potentially reach. There's a 61.8%, 78.6%, and 100%. These are the three key major projection levels. So you can see here, 61 price broke through 61%. Price found a little bit of support at around 78%, and price really found strong support at the 100% here. So these projection levels can also be used as take profit targets on the short side. So the dollar index has reversed off 106 and is falling. We run a Fibonacci projection from here, 0.1, 0.2, 0.3, right? And then the projection levels here, 61.8%, 78.6%, and 100% help us identify potential take profit levels for the short trade, right? So this is how we can use a projection level as well. But for now, you can see price is already hit 100%. So this projection is no longer valid, right? So let's just get rid of it. Now, okay, now let's move on. Let's look at it. Let's add the Ichimoku cloud to it. We can see previously the dollar index was trading above the bullish Ichimoku cloud and did a crossover a crossover back in 6th of June, but price reversed strongly. But this time here, the crossover, the cross below or the break below the cloud was a much more sustained and deeper move move to the downside, which has caused the bullish Ichimoku cloud here to turn red as well, right? So the Ichimoku cloud in red highlights the bullish momentum, the current bullish momentum for this index or for any other instrument that you're trading. All right. Now looking at it on the 4 hour time frame here, we can see that. All right. Now on the 4 hour time frame, we're going to adjust this bearish channel. Sorry. So previously this bearish channel would have been looking like something like this here. Okay, it's not really the best bearish channel. But now that you look at it on the 4-hour time frame, it would have looked something like this maybe at best. Yeah. So on the 4-hour time frame, the bearish channel would have looked something like this over here, right? So initially we would have used this 1, 2, 3 for the lower trend line, and for the top would have used one and this part here. So initially would have probably looked like something like this. Right. Okay. So now we can see this breakout occur last Friday, right? There's a bullish breakout through the bearish channel. Uh, so for now, there's been no uh follow through, right? Price has sort of consolidated between 104.16 and 104.50, a relatively tight range of about 35 pips here. Price has just gone sideways after making this breakout, right? So far, there's been no sustained continuation, or there's no sustained follow through. However, with PCE price index coming up tomorrow. And of course, tonight we've got GDP and unemployment claims up as well. Those are the macroeconomic releases that could very well function as the next strong catalyst for the dollar. All right, okay. So now that we've identified the major resistance and support levels, what do this mean, right? So that means here, in the current context, let's just assume, right, we get a combination of so tonight we've got GDP data and unemployment claims. So let's just say the advanced GDP estimate is 2% and the result comes in lower than that. So that means we've got a weak GDP number. And let's just say claims comes in higher than the forecast, right, which signals potential weakness in the US labor market. So these are all negative news or data points for the US dollar. So that means we're quite likely to see the dollar index pull back. So if we get a GDP miss and that's accompanied by higher unemployment claims, that's quite likely going to function as a strong bearish catalyst for the dollar. So that means dollar index is likely to fall lower. So we do see the dollar index falling lower, right? That means we can use this the vicinity of the first support, which is at around 103.65, to identify your take profit level as well, right? Now that we're in the 4-hour time frame, we can also draw a Fibonacci retracement here, starting from this low, 17th of July, going up to the high here on the 24th of July. Let's pull up all the fibs, right? Not only can we use this first support down here at 103.65 as a potential take profit level for the short trade, we can also use, for example, I see a nice support level here as well, right? As I see a nice intermediate support level here at 104. That's bounded by the 61.8% Fibonacci retracement. So this can be the first take profit level as well, right? Right, there's a nice 61% Fibonacci retracement, as well as this pullback support level at 104. Right, so this is where the first take profit level for any short dollar index trade can be identified. And of course, should price continue to fall lower, then we can then target the first support at around 103.70 as the next take profit level. So take note, if you get a result, a GDP miss and higher claims, this is quite likely going to function as a bearish catalyst for the dollar. So that means dollar index could quite likely reverse and drop lower. First take profit level for the short trade can be identified at the 61.8% Fibonacci retracement here, which is at around 104. And the second take profit level can be identified at around 103.75, just slightly above the first support. Now, let's just say the data comes in the other way. We get a stronger than expected GDP data that's accompanied by lower claims. Now, that means that's quite likely going to function as a strong bullish catalyst for the dollar. So that means dollar index is quite likely going to resume the uptrend here. So that means because we have identified this first resistance here at 104.50, that means your first take profit level can be identified here at the first resistance, which is at 104.50, and the next take profit level can be identified at this pullback here. So we see there's a nice pullback level here taking place on the 8th of July. This is like an intermediate resistance level. So we can then target the second take profit level for any long dollar index trades at around 104.80, right? So just to summarize, if we get a strong GDP number that's accompanied by lower claims, we are quite likely to see the dollar push higher. And if it does push higher, we will be using the first resistance at 104.50 as the first take profit level, And the second take profit level is going to be identified at 104.80, which is this pullback level here that occurred on the 8th of July, right? So these are the two scenarios that we should be prepared for, right? Because we don't really know which way the data is going to swing, right? So just be prepared and see whether the price action conforms to what the data has been released as well, right? So if we do see a set of data that's going to be bullish for the dollar, we also got to make sure that price action conforms to that outcome as well, or conforms to that result. And conversely, if the data is going to be negative for the dollar, we should also be expecting to see the dollar index pull back quite sharply as well. All right. Okay. So these are the key levels for the dollar index for today, right? Daily time frame, H4 time frame, and how we can uh, be aware of the data that's going to be released today and how it could potentially drive the direction later in a couple of hours, right? So it's going to be released in about 3 hours. Yep. So unemployment rate, unemployment claims and GDP data is going to be released in about 3 hours. Right. Okay. Now that we've had a look at the dollar index, uh, let's take a look at dollar yen as well, right? We've seen significant strength in the yen, right? This is a combination mostly driven by the intervention measures by the Bank of Japan that took place in the second and third week of July, right? So intervention measures are basically the central bank actions taken by the central bank in Japan. They're actually buying back, they're actually selling the US dollar and using the proceeds to buy the Japanese yen in the open market, right? Because you can see when you look at the dollar yen on the weekly time frame, you can see it as dollar yen has risen very significantly since January 2021. Right, so when the dollar yen is rising very strongly like this, it means the Japanese yen is getting very weak, and that's not good for imports. Okay, for exports, it makes Japan's exports very attractive. It makes inbound tourism very attractive as well. On the flip side, purchasing power of the Japanese citizen reduces, and of course, their imports become more expensive as well. So they cannot have a situation where the yen is getting weakened significantly, as what we've seen since January 2021. So they have intervened in the open markets previously as well. Back in the third quarter of 2022 and the fourth quarter of 2022, you see dollar yen hitting a high of 152 here in mid-October 2022, and it reversed sharply to drop down. So this period here was also a phase where the Bank of Japan was actively intervening in the open market. So they were selling their foreign holdings, which was basically the US dollar, US treasuries, and then using the proceeds of those sales to buy the Japanese yen in the open market. So when they're buying the Japanese yen in the open market, the yen gets strengthened. So the yen is strengthening. That means currency pairs like the dollar yen are falling. Pound yen is falling, Aussie yen, Kiwi yen, so on and so forth. So this is something that's happening right now as well. So over the last couple of weeks, the Bank of Japan has intervened in the open market once again, which has caused the dollar yen to reverse and pull back very sharply, right? So now this is quite an interesting trade as well. So that means for now, right, the bias for dollar yen is clearly to the downside. So any retracements to the upsides would be a potential entry point as well. There's a potential sell entry. So of course, with this currency pair falling quite sharply and this yen strengthening very significantly, naturally the bias for uh, any currency pairs that involves the yen would be potential short entries as well. Right. Now, where's the next? Let's identify the major support and resistance levels here. So let's start on the daily time frame. Right. Right. Okay. So price has just broken through. Uh, Today has made a bearish breakout below this support level here. Right. This was previously a very significant swing low support that took place here on 6th of May. Right. It's a very significant swing low support here. You can see a dollar yen has actually broken many levels. Right. There's a nice pullback support level here at 158.40 that was taken out in the second week of July. We had another nice pullback support level here at what is this, 155 that was also taken out yesterday. And finally today we are in the process of seeing another key level being taken out as well. You can see dollar yen is not finding a floor, it's just making lower lows day by day. Right. So for now, I'm just going to keep this first support at 152.92 on hold yet. because of course, quite clearly, we've not seen a clean break below this level just yet. Maybe on a 1 hour time frame, it's a clean break. Yep, 1 hour time frame, we see the nice clean break. Right, so because of that, this level now is quite likely going to function as our first resistance. Remember, once support levels get taken out, usually they can end up functioning as resistance in the future. So that's what we're doing right now over here. Now, the next major support that I see for dollar yen is this swing low here that took place on the 11th of March. We see a nice swing low taking place here, and we see another nice swing low on the 1st of February as well. So we see like a multi-swing low support level at around 146. And this is like the next major support for dollar yen. In between, there's a pretty decent pullback support level at around 151.73, right? It's a nice pullback support level here. So we can highlight this more like a zone here. So the next immediate support level for dollar yen looks to be around 150.80 to around 151.80 as well, right? It's quite a wide range, but yeah, but for now you can see that the bias for this currency pair is to the downside as well. So that means if you're shorting the dollar yen or if you've been shorting the dollar yen, like looking at this first support at around 151.70, this would be a good area to identify as a potential take profit zone for any short dollar yen trades, right? So it's good, pretty good, decent take profit zone here. Now we can also run a Fibonacci retracement starting from this swing low at the end of December, going up to the high here on the 3rd of July. We can see that this first support zone also has the presence of a 51.8% Fibonacci retracement. So let's just keep that on over here. And we can identify the second support at this multi-swing low that I mentioned earlier at 146.40. Right, so these are the key support levels. Also just keep 50 and 61% here. These are the key support levels for the dollar yen. And these are important levels because we are then going to use these levels to identify potential take profit levels or zones for the short trade. So that means if you've been shorting dollar index around, right, or even as recently as today, right, even if you're shorted at about 153.50 or about 153, your first take profit level can be identified around this first support, around the 50% Fibonacci retracement, right? So your first take profit level for the short trade can be identified at around the 50% Fibonacci retracement. And of course, if we do see this currency pair continue to fall even lower, we can then use the 61.8% Fibonacci retracement, which is around 148.50 as the next take profit level. And finally, should it even drop even further, we can then use the second support, which is at 146.40 as the third take profit level here. So TP1 is around the 50% retracement, TP2 is around 61%, and TP3 is at around the second support here. Right. Now we can also run a couple of Fibonacci extensions. Let's just see if any of the extension levels can be used. Extension levels in this case also help us identify potential uh take profit levels as well. Okay, extension at 127 has been broken, so it's clearly not in use. 161 is down here. Okay, I think for now probably it's not necessary to use any of the extension levels for now. I think it's fine. Yeah, I think the Fibonacci retracements along with this multi-swing low and this pullback level here is sufficient enough to identify the major support levels here. All right, now look at it on the 4-hour time frame for the dollar yen. Right, we can see now, even as of now, we can see it the current 4-hour candle is dropping lower as well. So really the bias is to the downside here, and especially with dollar yen trading underneath the bearish Ichimoku cloud, this itself also indicates or highlights rather, I would say highlights the bearish momentum and the bearish bias as well. All right, so take note, the yen is very significantly strong. So when you look at it on the dollar yen as well, you look at it on dollar yen as well, you can see here, right, it's like practically the free fall as well. On the 4-hour time frame, it's trading underneath the bearish Ichimoku cloud, and it's literally in a free fall. Even euro yen, similar market structure, similar momentum, right? So take note of that. The yen is significantly strong since mid-July. And as of right now, there doesn't seem to be any real flow for any of the yen crosses for now. All right, okay, so that's what we have for the dollar yen. Let's move on over to gold. Let's cover gold now. We'll cover gold and oil, and maybe we'll cover some of the indices. And of course, should there be any requests for any other instruments, do let me know early. Be more than happy to go through the analysis. Yeah, do not leave your requests till the end. Just drop them in the chat box, and I'll be more than happy to go through the analysis with you. All right, now let's look at gold prices here. So this XAU USD is an instrument for spot gold, right? So we can see a gold has made an all-time high, a new all-time high this year on 17th of July, hitting 2,483, right? So quite clearly, this is the all-time high for gold over here. And also see a nice pullback resistance level taking place here on at the beginning of this week as well. So the first resistance for gold is going to be around this pullback resistance level here that took place on 23rd of July. That's our first resistance. And of course, the second resistance is close to where the all-time high took place. Right. Now, with price falling lower, where can we find a nice support level? I see a pretty decent support level here as well. There's a nice pullback level here that's been in place. It's been in place since 1st of May, right? $2,286 per ounce is a very strong support level. But what about anything in between? Let's see if we can find anything in between. Right, when I look across this level here at around $2,360 per ounce, I see a nice overlap level, right? I see a nice overlap here that's formed. No, hang on. Where did we go? That's formed by this pullback. There's a pullback resistance that occurred here on 20 years and 21st of June. The gold pulled back, then it broke out of this level, then it proceeded to function as support on the 8th and 9th of July, so thus creating an overlap. So this was previously a pullback resistance level, which then proceeded to function as a support, which in turn makes it now an overlap support. So that's how we've identified the first support for gold, which is at $2,360 per ounce. So that means now as gold prices are falling sharply, right? Today is a pretty big down day. So by identifying this support level here, we should be targeting our take profit at around $2,365 per ounce, right? So close to this level here. Now, we can also run a Fibonacci retracement on this uptrend, starting from this low on the 26th of June, going up to the high here on the 17th of July. Let's pull up all the fibs. We can see that the 61.8% retracement aligns pretty well with our first support as well. So this is going to be a pretty critical support level for for gold. So we're going to keep 61 and 78.6. So that means here your take profit level should be identified. You can see here the bottom of this wick has actually just ticked the 61.8% retracement, right? When we look at it here, you zoom in a little bit here, you can see the bottom of this wick has actually just nicely touched 61.8% and has retraced a little bit higher, right? So we can see quite clearly that this is indeed a very significant support level. So any short trades, right, identifying your take profit level at around the 61.8% retracement for the short trades is actually a suitable area to do so. Of course, there's not saying that price is not going to retrace higher. Gold can continue to fall. What could cause it to continue to fall today? Perhaps if we see a strong set of economic data on the US. So if we get strong GDP numbers followed by lower claims, that could be the catalyst that's going to cause gold prices to fall, right? Because if higher GDP and lower claims cause the US dollar to gain in strength, that's quite likely going to cause gold prices to drop. Remember, gold and the dollar share an inverse relationship. So that means when the value of the US dollar is getting stronger, typically gold prices are pulling back. And conversely, when the value of the dollar is falling, typically this functions as a tailwind for gold prices as well. Right. So take note, if you're shorting gold, the take profit level should be identified at around 61, at around the 61.8% Fibonacci retracement, which is at the price level of around $2,367 per ounce. Right, now let's look at it on, okay, wait, before that, is there anything else that I want to highlight on a daily time frame? We've done Fibonacci here. That I think, okay, I think that's fine. Now let's go down to the 4 hour time frame. Let's see, does it need to fine tune the analysis? All right, it's a 4 hour quite clearly. Okay, we need to adjust the first resistance. The pullback actually takes place here. So when I use the 4 hour time frame, I'm usually going to use the body of the candle. That's what I did for the daily time frame. But you can see here 4 hour, I've got to move it up here. So that's fine. The first resistance is at around 2,241 dollars per ounce, and the second resistance is at, of course, here the all-time high on 17th July. Right, it's quite clearly you can see. It's just so when you drop down the time frame, like especially from the daily to the 4 hour time frame, it's fine to readjust or fine tune some of the levels, right? Because we're trying to use the body of the candle to identify those resistance points. Now you can see here exactly here this current 4 hour candle has exactly ticked the 61.8% retracement before bouncing a little bit higher, right? So if you had done your analysis beforehand, of course, and you was shorting gold prices today, right? Using this 61% retracement would have been a good level to identify your take profit here. Right, so these are the key levels for dollar index. Sorry, for gold for today. And let's see, let's cover one more commodity. We'll look at WTI oil. Then we'll come back to the currencies as well. If there's anything, I will cover the indices. Right, we've seen a very strong pullback in US equity markets over the last few trading sessions, right, led by poor earnings results out of Google, Tesla, as well. Most recently, Google and Tesla, right? So that's caused a strong sell-off for these at the index level for the Nasdaq. Now, WTI oil crude prices have been in a downtrend since the first week of July as well, right? Crude prices hit a recent high of $84.65 per barrel in the first week of July, and has tumbled ever since, right? Again, similarly, for crude oil, there doesn't seem to be a floor at the moment, right? We can't seem to find a floor for crude oil at all at the present moment. Where I do see a pretty decent intermediate support level could be at $76.20 per barrel, right? We see WTI oil previously finding support here in mid-Feb, end of February, and of course in mid-May and at the end of May as well. So this is not the strongest support level here because we see this cut through here, right? We see this double cut here. But this level here at $76.20, I'd like to identify as intermediate support level. But where I do really see the major support coming in is at this swing low that took place here at the beginning of June, right? We see a nice swing low taking place here at the beginning of June, which also aligns pretty well with the swing low that took place in the first week of Feb. So we've got a nice multi-swing low support at around $72 per barrel. So that's where the first major support for crude prices are going to come in. Now, this intermediate support level is key as well at $76.20 because this intermediate support level can also be used to identify your take profit for the short WTI oil trade. So if you've been shorting oil from about, well, let's just say from today, right, from about $78 per barrel, right, we should be targeting the first support. Sorry, we should be targeting the intermediate support as the first take profit level here, right? So ideally, anywhere from $76.70 per barrel and below should be your first take profit level for short WTI. Now, of course, as I mentioned, this multi-swing low here is very important as well. This is the first major support for WTI oil right here. Right now, we can also run a Fibonacci retracement on this uptrend, starting from this swing low on the 4th of June, going up to the high on the 5th of July. We can see now that WTI oil is currently testing the 61.8% Fibonacci retracement. This is a level where it bounced off on Tuesday as well. It bounced off this level on Tuesday, stabilized, or well, it was quite a volatile day on Wednesday as well. It sort of stabilized, managed to close in the green, but it has resumed a downtrend today. And will this level hold today? Let's just see. It's definitely testing it much more strongly today. And we may see it actually drop down close to this intermediate support at $76.20 per barrel. So looking at 61.8% here, I would have also used this level here to identify, I would be getting ready to identify a potential take profit level for WTI oil over here. Right, okay, the one more thing I would like to do and here we have a 78.6% retracement that aligns pretty well with this little pullback that occurred on the 7th of June. So this 78.6% retracement can also be used as the next take profit level. So let's assume that we see crude prices smash through the 61.8% retracement, as well as dropping through the 70s, the intermediate support at $76.20. That means I would then use the 78.6% retracement level as my next take profit zone, right? So this is how we can use key support zones to help us identify take profit levels, especially when we're seeing strong bearish momentum or strong bearish downtrend, such as what we're seeing now in WTI oil. Now, what about resistance here? Right, I would probably use this pullback here as a pullback level that occurred here on 20th of May and 31st of May. This was a pullback resistance, which may offer some, which could be used to be identified as the first resistance here, right? So that means as price retraces higher, this is what we can, why we can expect crude prices to potentially stall as well. And the second major resistance for crude oil is going to be at this pullback level here that took place on the 10th of July. Right, now let's look at it on the 4-hour time frame. Right, I think this is fine. Right, in 4-hour time frame, it's quite clear. We're seeing a series of lower highs, series of lower lows very clearly, with a nice downtrend here as well. You could probably draw a bearish channel here as well. Yeah, we've got a pretty decent bearish channel down here as well. All right, okay, great. So these are the key levels for WTI oil. We're seeing very strong bearish momentum, and this is quite likely going to drift lower as the day progresses as well, right? Looking at a weekly basis, I think this is going to be a very strong down week for crude oil, right? Most certainly on track for the third weekly loss for WTI oil here. It's let's see, it's gone from what, $83 per barrel down to as low as 77. Yeah, it's lost $6 already. It's lost almost like 8% in nearly 3 weeks, right? Quite a big pullback in crude oil prices here. Right, now let's cover the Nasdaq, right? Let's cover the Nasdaq. We've seen a strong sell-off in uh let me see. Right, we've seen a strong sell-off in the Nasdaq as well, of course. So let's start with that here. Okay. Right. Okay. Before we continue the analysis of on the Nasdaq, right? I'm just going to launch a poll and truly appreciate it if you guys can give your feedback with regards to today's webinar, and then we'll continue with the analysis once the poll is done. All right. Truly appreciate it if you guys can give your feedback with regards to today's session. All right. Leave the poll running for about another 20 seconds or so. All right. Great. Truly appreciate the feedback. Thanks, everyone. Thanks so much. All right. Okay. Just let me see. All right. I think most of you, or pretty much all of you, have answered. All right. Great. Just keep it running for about another 5 seconds or so, in case anyone's missed out. All right, great. Thank you so much. Truly appreciate it. All right, great. Okay, now let's just continue the analysis on the Nasdaq, right? So you can see here, all right, let's start with the weekly, because I like when I do the analysis on the indices, I like to start it on the weekly time frame where you really get to see the major momentums and trends. So we can see here, this is the all-time high, or the intraday all-time high for the NAS 100, which hit 20,758 back on 8th of July. Right, so quite clearly, this zone here is the first resistance for the NAS. And with it pulling back very sharply, where can we identify major support? I see a nice overlap level here, right? I see a nice overlap level here at around 18,432. We can see that previously, back in the end of February and early March, 18,430 functioned as a resistance. This was a previous all-time high for the NAS back in end February, early March. And then after which, when price broke out of it, it found support here on the week of 27th of May before reversing to bounce higher. So this creates an overlap level here. So this is the first major support for the NAS 100 here, right? Now, the next major support for the NAS looks to be at this pullback level here. Actually, it's also like another overlap, right? We see a nice pullback resistance here back in November of 2021. You see a nice swing high, sorry, it's a swing high resistance in November of 2021. We see a little pullback resistance here on the 25th of December last year, and we see a nice support over here as well. So this is creates an overlap level here. So this is where the next major support for the NASDAQ sits at. And we can also highlight this as a zone over here. Right, now that we've identified the support levels, we can also run a Fibonacci retracement. We see a very nice uptrend here, right? I believe we can even see, okay, no, we don't really have okay, it's a pretty decent bullish channel, right? Yeah, I think most of you will agree that this is a pretty decent bullish channel. It's not the best bullish channel, but yeah, you can see you can see where I'm getting at. It's a pretty decent bullish channel as well. See a couple of touches to the top. Just unfortunately, just one touch to the bottom here, but generally we can see it highlights the bullish uptrend very clearly. Right now, we can also run a Fibonacci retracement, starting from this low here in October of 2022, going up to the all-time high here. Let's pull up all the fibs. We can see that the 23% retracement aligns very well with the first support, while the 38% lines up very well with the second as well. So we can see that not only do we have significant overlap levels, we also have the presence of Fibonacci retracements to add further significance to these support areas. Now, so what does this support area mean? So that means if you have been shorting the NASDAQ, right, that means you'll be looking at this first support area at around 18,500 as a potential take profit. Of course, there'll be intermediate take profit levels along the way, right? One intermediate take profit level would have been around here, right? Previously, this level at 19,600 was a small pullback level here that was in place since 17th of June till the 1st of July, right? This level here functioned as a strong, as a little pullback support level here. And then as the Nasdaq reversed sharply in the second and third week of July, we would have identified 19,600 as the first take profit level. And now that price has continued to drop lower, this index has continued to drop lower, we'll be using close to the first support, so around 18,500 as the next potential take profit zone for the short Nasdaq trade here, right? Okay, now let's look at it on a daily time frame and see if there's any if we can fine tune the analysis, right? We can actually add another Fibonacci retracement now. There's a nice uptrend here on a daily time frame from 19th April up to the all-time high. Let's pull up all the fibs. We can see that the first support here also has a presence of a 61.8% retracement, right? There's a 61% retracement that aligns quite close to the first major support. So we have identified a nice take profit zone for the short Nasdaq trade. So we have a combination of this overlap support at 18,430 and the 61.8% Fibonacci retracement at 18,655. Right, so this is how we've identified a pretty decent take profit zone for the short Nasdaq trade. And not only that, on a daily time frame, we can see price. This index has also entered the bullish Ichimoku cloud. Remember, the bullish Ichimoku cloud can also function as an area of support. So this is where we should be ready to see price potentially stall as well. So that means we should be looking to close out any short trades as soon as it gets to the 61.8% retracement. You can see here, back in April, in this scenario, the bullish Ichimoku cloud did not function as a support zone. Price actually, the Nasdaq actually broke through the bullish Ichimoku cloud and it found support at around, or it stabilized at around 17,100 before reversing to climb higher. So in this case here, back in April, the Ichimoku cloud did not function as an area of support. Let's see if this time round it does hold, right? Especially with the 61.8% retracement that we've identified as along with the overlap support as well. All right, okay, so that's what I've got for today, right? All right, thanks everyone for tuning in to today's webinar, right? Do look out for all upcoming webinars for IronFX for the rest of next week as well. All right, I wish you all the best in your trading journey, and of course, more importantly, have a great weekend as well, right? Don't forget to recharge and unwind yourself with your friends and family as well. All right. Thanks, everyone. Take care. Have a great trading week, and most importantly, enjoy your weekend as well. Right. Thanks, everyone. Take care. All right. Thanks, Toph. Great to see you again. All right. Most welcome.